Defined benefit plans have been cycling out of the industry for the better part of 4 decades, but the ensuing obligations continue to linger, leaving some plan sponsors particularly sensitive to the prolonged low interest rate environment. Senior industry research analyst George Hansen joins us to discuss the implications of today's market conditions on the accumulated pension obligations that some insurers hold, which are detailed in a new report. George, can you establish a baseline for us here on what's happened with the volume of these defined benefit plans since year-end of 2016?
Yeah, sure, John. The number of rating units with defined benefit plans has shrunk about 30% from 257 rating units down to 184. And this continues the trend from our last report, where there were 291 rating units with defined benefit plans at the end of 2013. The accounting changes probably had a lot to do with that, requiring insurance companies to recognize unfunded obligations on their balance sheets. This was an accounting pronouncement made at the end of 2012, and it probably accelerated the decline in the number of rating units with defined benefit plans.
While the discount rate that insurers can use factors into play, so does the return on assets ratio. How have insureds fared with these two measures over the past few years?
There have been changes in the discount rate used to determine the cost of the benefit plans. It is gradually declining from around 4.25% to 3.7% by 2018. It ticked up in 2018 to over 4%, but then took a big drop to 3.42%. At the same time, the investment returns kind of mirrored that change in interest rates. When interest rates went up, insurers reported modest losses, but when rates have gone down, they've reported fairly healthy gains of 15 to 20% at times, and this has offset some of the pressures from the increased cost of the benefit plans themselves.
Now, based on your earlier review of the 2020 statement filings, what might likely happen with these benefit obligations as we move forward?
Well, John, the 2020 indicated discount rate for plan obligations dropped another 80 to 90 basis points. So companies have to determine the obligations at a rate of around 2.5 to 2.6%. So this is going to increase benefit obligations in the magnitude of probably 15 to 20%. At the same time, the returns on the pension plan assets was around 13% at first glance for 2020. So overall, we expect the unfunded gap to increase in 2020. Companies that have equity-heavy portfolios probably did better than those that don't. So it's putting pressure on companies to search for yield and go into more risky assets.
George, thanks for taking the time to speak with us today.
Thank you, John.
That was Senior Industry Research Analyst George Hansen. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.